It's that time of the year where the world turns to the World Economic Forum in Davos, Switzerland. The mountains, the snow, and big business leaders gather in one place to talk, well, business. And for the 19th year in a row, PricewaterhouseCoopers released its annual Global CEO Survey. And some of the results are astounding, as two-thirds of CEOs, 66%, see more threats facing their businesses today than 3 years ago. Speaking on the U.S. findings is Bob Moritz, PricewaterhouseCoopers U.S. chairman.
The main findings for the U.S. as it relates to the CEO survey is that the U.S., on a good note, has actually been a beacon of light relevant to the economy and will continue to do so, albeit at low growth rates. On the sad side of the equation, overregulation continues to be the number one concern. And it's historically been there. It's even gotten worse this past year. As a result, CEOs are also worried about trade from a global perspective as well as with domestically, with regulations in mind and trade and cap issues that are associated with it. Two other things that are really important to them. One is around the customer and broader stakeholder needs as they continue to expand. And second is the issue of taxation. The U.S. CEOs are concerned that the government hasn't done enough around the tax code, simplification of it, the effectiveness of it, and they feel like there's an opportunity. And we have a degree of confidence now coming through that there's some prospects to lay the foundation for further tax reform as we look ahead into 2016.
Meanwhile, just over a quarter, 27% to be exact, believe global growth will improve over the next 12 months, a decline of 10 points from last year. And also, the annual Global CEO Survey shows only slightly more than one-third, 35%, are very confident of their own company growth in the coming year. That's down 4 points on last year and even 1 point below 2013. So what do CEOs plan to do with all of this data? Well, one more time, here's Bob Moritz.
As a result of the findings, here's what CEOs plan to do. Number one, they continue to focus on technology. It's an enabler for digitization, consumer confidence in terms of the connectivity to it, and an ability to produce effective and efficient returns. So technology is key as a focus point. Number two, in order to do that, actually get the next generation of millennials as leaders in their organizations. These are individuals that are adept in the skills around technology, and you want to skill them up in terms of leadership responsibilities to have the impact that they normally have. Third, you actually want to make sure you leverage technology to connect with your consumers, your customers, as well as your broader stakeholders. And then as it relates to growth, since the U.S. seems to be at least that beacon of hope out there, you'll see a lot more domestic and some international M&A activity. In addition to staying holdfast with respect to the investments they're making in China, there's an opportunity with that annuity stream coming out of the U.S. to stay a little longer in China while expanding on a portfolio mix basis around the rest of the world in terms of the areas of investment that they actually want to do for both the short term as well as for the long-term opportunities that they're seeing ahead of themselves right now.
So, do you agree with these findings? Is there a reason for CEOs to be more concerned? Let us know what you think by commenting on the video below. Feel free to subscribe to the Modern Wall Street YouTube page and follow us on social media.